There is a moment in every financial era where the window between knowing and acting becomes impossibly thin. Most people never see it coming. They're staring at their brokerage screens, watching the numbers tick, and they feel safe because the numbers are still ticking. They don't realize that the floor beneath those numbers has already cracked. You are living in one of those moments right now. And this video is going to show you exactly why physical silver, not paper silver, not a silver ETF, not silver futures, physical silver in your hands is no longer a fringe investment idea. It is the single most logical, most historically validated survival tool available to ordinary Americans today. I want you to think back to something. Think about where you were when you first heard about inflation becoming a real problem. Most of you didn't believe it at first. You thought it was temporary. The Fed said it was temporary. The Treasury said it was temporary. Every talking head on cable news said it was temporary. And then you went to the grocery store, and nothing was temporary anymore. The price of eggs, bread, beef, insurance, everything you actually need started climbing in a way that your paycheck couldn't keep up with. That's not an accident. That's not bad luck. That is the predictable, mathematically inevitable consequence of what has been done to the money supply over the past several years. And silver, specifically physical silver, is one of the very few assets on Earth that has historically not just survived that kind of monetary destruction, but thrived inside of it. Let's start with where silver is right now, because the number sitting on your screen doesn't tell you the full story. It actually understates the real situation dramatically. Silver is trading at approximately $68 an ounce. And before you say, well, that's already moved a lot from where it was a couple years ago, I need you to understand something important. That price is being artificially suppressed by a paper market that is operating in a way that cannot be sustained indefinitely. We're going to get into exactly how that works in a moment, but first I want you to understand the magnitude of the gap between what silver is worth on paper and what's actually happening with physical silver in the real world. The silver market has been running a structural supply deficit since 2021. Not 1 year of deficit, not two. By the time you are watching this video, the cumulative shortfall between how much silver the world has consumed and how much has been mined is approaching 900 million ounces. 900 million ounces. Let that sink in. For context, total global silver mine production in a given year runs somewhere around 800 to 850 million ounces, which means the world has consumed more silver than an entire year's worth of global mining output just in the deficit alone, on top of all normal consumption. And yet the price has not yet reflected that reality the way it eventually must. That gap between the physical reality and the paper price is where your opportunity lives. Now, if you've been watching this channel for a while, you know I like to connect these big abstract numbers to real human stories. So let me tell you about the dynamic that is building right now underneath the surface of this market, because it mirrors something that has happened before, and understanding what happened before gives you the roadmap for what is about to happen again. Go back to the late 1970s. You had an America that had just been through years of inflation, geopolitical chaos, the oil shock, a currency that was no longer backed by gold. Nixon had closed the gold window in 1971, and a general sense among ordinary Americans that something had broken. Confidence in paper was fracturing. In that environment, a family of Texas oil billionaires named the Hunts, Nelson Bunker Hunt and his brother William Herbert Hunt, made a decision that would become one of the most studied events in commodity market history. They began quietly, methodically, accumulating physical silver. Not paper contracts, physical silver. They understood something that most market participants were missing entirely, that the paper silver market was essentially a fiction built on top of a very small foundation of real metal. By the time the Hunt brothers had accumulated somewhere in the range of 150 million ounces of physical silver, the price had gone from roughly $2 an ounce in 1973 to nearly $50 an ounce in early 1980, a 25-fold increase in roughly 7 years. Now, I'm not telling you the Hunt brothers story because I think history is going to repeat itself in the exact same way. I'm telling it to you because the structural mechanics of what they exploited are still present in this market today. And in some ways, they are more extreme now than they were then. The ratio of paper silver to physical silver that can be delivered is staggering. At various points in the COMEX trading data, the number of paper ounces outstanding relative to the registered silver available for delivery has reached ratios that would have seemed insane to a market observer from 30 years ago. What this means in plain English is that a large enough demand for actual physical delivery could trigger a price movement that makes the Hunt Brothers episode look mild by comparison. And before we go deeper into that, if you're someone who is already thinking about how to protect your hard-earned retirement savings, I want to point you to something. In the description below this video, I put together a completely free guide that shows the saving strategies that thousands of American retirees are already using right now to protect their wealth from exactly the kind of monetary chaos we're discussing. It covers things that most financial advisors either don't know about or won't tell you. Check that out. Link is in the description below. And then come back, because what I'm about to show you next is the part that most financial commentators are completely missing. Let's talk about why this time the physical silver situation is fundamentally different from any previous era. In every historical silver bull market, silver's demand was primarily monetary or industrial in nature: jewelry, silverware, photographic film, basic electronics. But we are now living inside what might be the greatest convergence of silver demand drivers in the metal's entire recorded history. Consider what is happening simultaneously, right now, across multiple sectors of the global economy. Start with artificial intelligence. Every AI data center that gets built, every server rack that gets installed, every neural processing unit that gets manufactured requires silver. Silver is the most electrically conductive metal on the periodic table, period. Not almost the most, the most. And modern AI infrastructure is extraordinarily silver intensive in a way that was not true of previous technological eras. The thermal management systems, the circuit breakers, the connectors, the printed circuit boards, they all require silver in quantities that are not small. Global data center power demand is forecast to roughly double or more before the end of this decade as the AI build-out accelerates. And every single watt of that build-out requires silver infrastructure. The AI companies building these systems don't care what silver costs. They need it. They will pay whatever the market demands. Now, layer on top of that solar energy. Silver is critical in photovoltaic solar panel production. Each solar panel requires a small but meaningful amount of silver paste in its cells to conduct the electricity generated by sunlight. As solar deployment has accelerated globally, driven by both economics and energy policy, the amount of silver being consumed just in solar panel manufacturing has become a major demand factor in its own right. And this demand is not discretionary. Countries and utilities that have committed to solar deployment are going to keep buying silver for solar regardless of where the silver price goes, because the alternative, not deploying solar, costs them far more. Then there's the electric vehicle transition. Silver is used in EV battery management systems, in the charging infrastructure, in the electronic control modules that manage everything from braking to acceleration. A fully electric vehicle contains significantly more silver than a traditional combustion engine vehicle. As the global fleet continues its gradual but relentless shift toward electrification, silver consumption in the automotive sector alone is going to continue rising for years. So you have AI infrastructure, solar deployment, and electrification all simultaneously pulling from a global silver supply that is already running a structural deficit. The mines cannot expand production fast enough to meet this demand. It takes a decade or more to develop a new silver mine from discovery to production, and the financing environment for new mining projects has been difficult. This is not a 6-month story. This is a multi-year structural supply shock that is building every single day underneath a price that has not yet fully reflected the reality. But here's the part that most silver analysis leaves out, and it's arguably the most important piece. All of the industrial demand I just described doesn't even get to the monetary demand that is building simultaneously on the global stage. Because while the Western financial media has been focused on equity markets and interest rate policy, something seismic has been quietly happening in the global monetary order. The percentage of global trade being settled in US dollars has been declining, not precipitously, not in a single dramatic event, but steadily, methodically, in ways that were almost unthinkable 20 years ago. Nations that were once firmly in the dollar orbit have been quietly negotiating bilateral trade arrangements in their own currencies. Central banks from countries across Asia, the Middle East, and Latin America have been steadily reducing their dollar-denominated reserve holdings and adding gold, and in some cases silver, as an alternative reserve asset. China, Russia, India, and a growing number of other nations have made no secret of their desire to reduce the structural dependence their economies have on a currency they cannot control. And when the dollar loses a meaningful percentage of its global reserve role, Not all of it, not overnight, but even a partial transition, the consequence for dollar-denominated assets is deeply negative, and the consequence for hard assets like silver is deeply positive. Think about what this means from a practical standpoint. Right now, one of the primary reasons the US can run massive fiscal deficits without immediately triggering a currency crisis is that there is persistent global demand for dollars to settle international trade. Oil has historically been priced in dollars, which means every country that imports oil, which is most of them, needs to hold dollars. If that arrangement continues to erode, the demand for dollars weakens, the purchasing power of dollars weakens, and the purchasing power of every asset that is measured in dollars has to be re-examined. The Federal Reserve cannot print more silver. No government can decree more silver into existence. And that is the core of silver's irreplaceable value in an era like this one. Let me take you back to another moment in history that carries important lessons. In 1971, when Nixon closed the gold window and ended the last formal link between the dollar and hard money, most Americans didn't feel the impact immediately. Life went on. The economy hummed along. But over the following decade, the purchasing power of the dollar was cut roughly in half. The people who had been cautious enough to hold silver and gold during that transition saw those assets multiply in ways that seemed almost impossible before the fact. The people who stayed entirely in dollar-denominated paper assets watched their savings get slowly, quietly consumed by inflation. That transfer of wealth was not dramatic or sudden. It was incremental. It happened quietly in grocery stores and gas stations and insurance premiums over years. And most people never even connected it to the monetary decisions that had been made years earlier. We are in the early stages of a similar transition right now. The monetary decisions that are going to determine who ends up on the right side of this, those decisions are being made today. And the window to position yourself ahead of the bulk of the public is still open, but that window is not going to stay open indefinitely. When the broader public starts to understand what is happening, when the narrative breaks through from financial commentary into mainstream conversation, you will see demand for physical silver jump in a way that will make it extremely difficult to acquire at anything close to today's prices. This is how it has always worked. The early movers accumulate quietly. The late movers scramble at much higher prices, if they can get it at all. Now, let's talk about something that the mainstream financial press almost never discusses because it requires understanding a market structure that is deliberately complicated. The COMEX, the commodity exchange, is the primary venue through which silver prices are set in the Western financial world. And the way the COMEX operates is that the vast majority of trading happens in paper contracts, not in physical silver. These contracts technically represent ownership of silver, but in practice, the overwhelming majority of them are settled in cash rather than physical delivery. The traders holding these contracts mostly don't want the actual metal, they want the price exposure. This means that the COMEX price, the price that gets quoted on every financial website in the world, is determined primarily by the behavior of paper traders, not by the physical supply and demand dynamics of the actual metal. For most of the time, this doesn't create a massive problem because the arbitrage mechanisms between paper and physical keep the prices roughly aligned. But when physical demand starts to surge, when enough people simultaneously want the actual metal rather than a paper promise, the system begins to strain. We have seen this strain emerge at various points over the past few years, with reports of extended delays in physical delivery, with premiums over the spot price expanding significantly, with certain dealers periodically limiting or suspending purchases. These are not normal market conditions. These are the early warning signals of a physical market that is beginning to disconnect from its paper shadow. And here's the critical insight about what this means for you as someone who is thinking about protection. If you own a silver ETF, a silver futures contract, a paper silver certificate, what you own is a claim on silver, a claim that is only as good as the institution standing behind it. In normal market conditions, that distinction doesn't matter much. But in precisely the conditions we are discussing, monetary stress, institutional strain, systemic disruption, the difference between owning a claim on silver and owning actual silver that you can hold in your hand becomes the difference between having protection and merely thinking you have protection. Physical silver is the version that cannot default. It cannot be frozen. It cannot be confiscated through a bank failure. It cannot be devalued by a boardroom decision. It has carried its value across empires, across currency collapses, across world wars, and across every form of financial crises that human civilization has produced. That is not hyperbole. That is a 4,000-year track record. And for those of you watching who are thinking about how to get physical silver or physical gold into a retirement structure so that you can get the protection of hard assets without losing the tax advantages of your IRA, I want to briefly mention something worth looking into. A gold IRA, which also allows silver, is a legitimate IRS-approved structure that allows you to hold actual physical precious metals inside a retirement account. It's not a workaround or a loophole. It's a specifically created legal vehicle that was designed for exactly this purpose. The way it typically works is through a process called a rollover, where funds from an existing 401k or traditional IRA are moved into a self-directed IRA that holds physical metal stored in an IRS-approved depository. You maintain the tax advantages of your retirement account, but instead of having your retirement savings exposed entirely to dollar-denominated paper assets, you have real metal backing a portion of it. Given everything happening with currency values, equity market volatility, and geopolitical risk right now, and the risks that are still building, that's a conversation worth having. Worth looking into it more if that's relevant to your situation. The guide in the description below covers some of the basics on how that works. Now let's get back to the analysis, because I want to walk you through what the technical picture for silver is telling us alongside the fundamental story. When you look at silver's price history through the lens of real purchasing power, not nominal dollar prices, but what an ounce of silver actually buys, you see something remarkable. Silver in real terms is still nowhere near where it was at its historic peaks. The nominal all-time high for silver was reached back in 1980 during the Hunt Brothers era at just under $50. But when you adjust that price for the actual purchasing power erosion in the dollar since 1980, and this is using the government's own inflation data, which most economists argue significantly understates actual inflation, the inflation-adjusted all-time high for silver is multiples of where silver trades today. We are talking about a significant price level that has never been retested in real terms since 1980. The gap between where silver is trading now and where that real value peak sits represents the scale of the repricing that the metal has in front of it if it simply returns to its historical norm in purchasing power terms. And the gold to silver ratio tells a similar story. For most of recorded monetary history, the ratio of gold's price to silver's price has averaged somewhere around 15 to 1, reflecting roughly the ratio in which these metals occur in nature. Right now, the gold to silver ratio is sitting at approximately 60 to 1, meaning silver is dramatically undervalued relative to gold on a historical basis. If the ratio were to even partially revert toward historical norms, not all the way, even a partial reversion, the implied silver price would be significantly higher than where it sits today, even at gold's current level of over $4,000 an ounce. Do that math quietly in your head for a moment. What I've been describing throughout this video is not a prediction that requires everything to go perfectly right. It doesn't require a particular government to fall, or a particular war to escalate, or a particular financial institution to collapse. All it requires is for the trends that are already in motion, the supply deficit, the industrial demand surge, the monetary de-dollarization, the paper-to-physical disconnect, the historical undervaluation, to continue on the trajectory they are already on. These are not speculative possibilities. These are documented, measurable, ongoing realities that have been building for years and that are accelerating. The question is not whether these dynamics will eventually force a major repricing of silver. The question is when. And more importantly, the question is whether you will be positioned before that repricing happens or scrambling to get positioned after it has already begun. Because here is the reality of physical silver markets when they move. They don't give you a polite heads up. They don't ring a bell. They don't issue a press release. What happens in a genuine physical silver shortage is that one morning you wake up, the price has jumped overnight because some piece of news accelerated the timeline. And then you call your dealer and discover that the wait time for delivery has extended to weeks. And then the week after that, the premium over spot price has expanded dramatically. And then the week after that, certain products are simply not available at any price. That is the dynamic that has played out in every serious precious metals run in modern history. 2008, the 2011 silver spike, the COVID disruption of 2020. In every case, the people who had accumulated before the storm had what they needed. The people who waited found the doors closing faster than they could move through them. I have been laying out a very serious case throughout this video, and I want to close by making it personal, because the data and history and market mechanics are only meaningful if they connect to something real in your life. If you are someone who has worked for decades to build a retirement nest egg, if you have savings in a 401k, an IRA, a pension, you did that work in a world where the dollar was stronger, where inflation was lower, where geopolitical stability was higher than it is today. The rules of the financial environment that you spent your career saving inside of are changing. Not because you did anything wrong, not because you made bad decisions, but because the monetary and geopolitical order that your savings are denominated in is under the most serious stress it has faced in generations. That is not a reason to panic, but it is absolutely a reason to act thoughtfully, deliberately, and with some urgency about ensuring that a meaningful portion of your wealth is protected in a form that cannot be printed, cannot be bailed out, and cannot be devalued by committee. Physical silver has been doing that job for 4,000 years. AI cannot replace it. Government cannot replicate it. The banking system cannot manufacture more of it. It sits there, quietly, holding value through every storm. And right now, with a structural deficit building under a price that has not yet reflected the physical reality, with industrial demand accelerating from multiple converging sectors, with monetary stress deepening around the dollar, and with the paper to physical disconnect growing more unstable, the case for owning physical silver has never been more compelling in modern financial history. If you are still watching this video right now, that tells me something important about you. It tells me you take your financial security seriously. You're not someone who leaves these decisions to chance or to hope. You want to understand what's happening, and you want to make intelligent decisions with that understanding. For those of you in that group who are American retirees with at least $100,000 in any kind of retirement account, I want to personally invite you to take advantage of something exclusive. In the description below, there is a free guide covering how thousands of Americans are using these strategies to protect their wealth. And for anyone who reaches out mentioning this video, we are making available a completely free, no obligation, one-on-one educational web conference where you can ask every question you have and get real, specific answers about how this applies to your situation. There is no pitch, no pressure, just an expert conversation about your options. That offer is specifically for American retirees with $100,000 or more in retirement savings, and it's available because the people who will see this video are exactly the people who deserve to understand what their options are. The link is in the description. Take advantage of it. The window for positioning ahead of this repricing is still open, but the nature of markets is that windows close, often when you least expect it. Physical silver. Know what it is, understand why it works, and make sure you're not one of the people who learns its value by watching it move without them.